All right, what's up? What's up, you guys? How's it going? This is Dollars and Cents with David and Carlo. What's up, Carlo?
Yo, how we doing?
Good, man. Really quickly, want to thank you all again for checking us out. We really do appreciate your time, and I promise you it will be well worth spent. Your time spent. So thank you again. So at the end of last episode, we touched briefly on the concept of being your own bank and trying to get that concept of what that means. And so, I guess I'd start off with the question of, have you ever heard of, or do you know what fractional banking is? And it's a concept that was created years ago for banks to be able to lend your money that you have deposited into your checking account with them and be able to lend it out to other people. And so we're going to touch on that later, but this is the idea and the concept of why we want to help you take charge and control of your money for various different reasons. But Carlo, what, in your experience, and the time that you've been doing this, what does that look like for somebody who is new to this and kind of the concept of being your own bank?
Yeah, I think first starting off with how does the banking system works. And I think because of the information age that we now live in, more people are privy to understanding how the bank is just straight hustling them. They're like, oh my gosh, I'm really starting to understand. You deposit your money in the bank. This is why they're on every corner, folks, right? Yeah. This is capitalism 101. Yeah. They're on every corner. They want you to direct deposit your money into their institution. And for every dollar that you give them, they could legally loan out 10. Okay, this is true, right? Fractional banking.
Fractional banking.
This is what they're doing. And so they will gladly take a few points off the top for them. Hey, we'll give you 1, 2, 3, 4% in a CD, whatever rates are going at the time of this video. They're paying you some yield, although not much, just enough to, just to give you an excuse, right? Just to keep, I don't want to say keep you happy, but just an excuse to play the game. You're getting something for it.
It's Pavlov's dogs.
Right? Totally, right? So you give your bank your money and they'll give you 1, 2, 3, 4%, and they're going to go and flip your money, typically at least 3 to 5x more than what they are paying you for.
And multiple times over.
Big time, right? So this is the game of leverage, right? So you give your bank your money and they say they're paying you 1%, and they could go earn 15% on letting someone else borrow the money that they have of yours. They're keeping a 14% spread. That's the game.
It's legal robbery.
It's what they're doing, right? So the whole point of these life insurance policies, right? Permanent life insurance, because you can do this with both whole life and index universal life. We're talking about IUL. Is banking on yourself means, well, if the bank could do that with my money, how could I do that with my own money? Mm-hmm. And that's essentially what you're doing with these life insurance policies. Mm-hmm. Is you are putting money into these policies, right? And you can then borrow against your account value. So let me be clear, because I also get a lot of questions that people think that they could borrow against the death benefit of the policy. You cannot borrow against the death benefit of the policy. Well, why not? Because there's no collateral there for the insurance company.
You're not dead.
You're not dead, right? You could only borrow based on dollars that you put in and has grown with interest. Right. Okay? So for the sake of this example, let's say you have $10,000 of cash value inside of your account and you want to borrow, right? And so let me backpedal, because there's 3 ways to pull money out of these policies, right? There's the sad way, the dumb way, and the smart way. Mm-hmm. The sad way is if you die, right? There's a death benefit attached to the policy that's going to pay out tax-free. So if I was putting in $10,000 into a policy, but I have a $500,000 death benefit, well, I'm no longer here, but hey, at least my wife gets a $500,000 tax-free death benefit that she doesn't have to worry about financially. Hope I took care of that. That's the sad way. The dumb way of accessing money from these policies is withdrawing the money. So if I have $10,000 in my cash value account, and I call the insurance company, hey, I need some of that money, they're going to ask me, would you like to withdraw it or would you like to borrow it? If you withdraw it, it's like a savings account. If I have 10,000 and if I have 10,000 and I withdraw 8, I only have $2,000 left in the account. Right. That's earning interest. So that's the dumb way. The smart way of accessing money from these policies is to borrow against the cash value. And then I get this question a lot, David, why would I borrow my own money? That's just stupid, right? Because that means I'm borrowing my own money with interest. No,
You're borrowing the insurance company's money.
Yes. Okay.
Right.
So if I have $10,000,
Use other people's
right?
money, people.
OPM, right? If I have $10,000 in my cash value account and I say, okay, I want to borrow $8,000 from this money, you're borrowing the insurance company's money. My $10,000 stays in the account, continuing to earn compound interest tied to the stock market index. If it performs, I make money. If it crashes, I don't lose a penny. This money, this $8,000 at the insurance company, they're going to charge me a nominal interest between 1% and 5%. Okay, talk with someone so you get those details, right? But they don't check my credit for that loan. It's a guaranteed loan.
Beautiful.
Here's the kicker. No monthly payments on that loan.
Say it one more time.
No monthly payments. So I borrowed that $8,000, no credit checks, no monthly payments, 100% tax-free, non-reportable. Why is it tax-free? Because it's a loan, right? So now I basically have created leverage here, right? I got my $10,000 still earning interest. Now this $8,000, I can go take that money and go invest it into another asset.
Have it make more money. And I think it's important for us to ingrain on that. This isn't for you to borrow against that cash value and go buy a car, which is a depreciating asset. The idea behind this concept and really truly behind the show is that we show you ways to have you make money on your own money.
Yeah.
Right. Ultimately, we want to compound that and 2x it, 4x it, 8x it through these methods. And so you need to make sure that you have a very clear mind and idea and plan on how you're going to be using this money to be able to make more money off of that. Because if it's just going to go to pay for a trip or whatever, it doesn't make sense.
Yeah. And I think it's important to understand how these loans work, because that's a very important part of this whole strategy. And so there is a loan there's a loan option. There's one of two, right? The first type is called the fixed loan, also known as a wash loan. And this will depend on how long you've had the policy, but hear me out on this so people understand it, because people say, yeah, you're still borrowing the insurance company's money, but you're paying interest. Let's talk about that.
Mm-hmm.
Right? So let's say if I borrowed $8,000 from my $10,000 cash value, and I've had the policy for a good amount of years, let's say they charge me 2.91% interest. Okay? So let's just round it up to 3.
Mm-hmm.
Right? You're going to pay 3% on that $10,000. That's $300. However, they're going to take the same amount from my cash value that they hold as collateral, and they're going to pay it also 3%. So if they're charging me 3%, but they're paying me 3% on the collateralized amount, they offset each other. It becomes a wash loan. Therefore, I have tax-free money.
That's beautiful.
With no monthly payment that I can go leverage and invest in another asset class.
Mm-hmm. And what was the other? Was there another?
The other type of loan is called the index loan, also known as a variable loan, which means I can borrow, say I have $10,000, but I want that $8,000 loan, and say, what type of loan do you want, Carlo? Do you want the fixed loan, which I just explained, or the index loan?
Mm-hmm.
Well, how does the index loan work? The index loan is, give me that $8,000. They're going to charge me 5%. That's the maximum that they can charge me. Now, this will depend on the company you work with, but I work with companies that have a max contractual rate of 5%.
And you want to have that. You want
that in writing, right? You don't want something to go higher than that. So how does that benefit me? I'd rather pay 3% than 5%, right? Well, in the index loan, I borrowed that $8,000, right? And I can go do what I want with it, but the money that they have collateralized, they're not going to pay it 5% like the fixed loan. They're going to let it ride the index. So if the index does 10% interest in my $10,000, right, then not only did I pay the 5% loan fee on the money that I borrowed from the $8,000, but I made an additional 5%, what we call arbitrage.
Mm-hmm.
So my money's making money on top of what I did with the $8,000 that I borrowed. Hopefully I'm making more money there too.
Right. And historically, you've seen those average rate of return on those indexes, maybe what?
And this is dependent on the company. So I'm going to be as average as possible, 6%, right? But I would say if you're doing it right with the right companies, you can get 7 to 10%, right? Very well.
That's beautiful. Beautiful. And so going back to the concept of this type of product, I know I want everything now. We all want everything now, but this is still a I don't want to say investment because it's a bad word in this, but it is a semi to long-term type of, for lack of a better word, investment that you want to make on yourself. So thinking that you're going to be able to cash this out immediately and do what you need to do, there's plans in place to be able to meet that particular criteria that you're looking for. But this is going to take a while. We're looking at, maybe 4 to 5 year plan. But after that 5 year, you're sitting in a really comfortable place.
Yeah. So depending on how long you're going to fund it, clients ask me all the time, how long should I fund this for? Depending on how long you're funding it for, I would say minimum 5 years, but you want to have at least a 10 to 15 year plan.
Mm-hmm.
For large amounts of premium, I got people putting $100,000 or more. I would say you can fund an IUL policy. We call it a 5-pay. Put it in for 4 or 5 years. You're done with it for life,
mm-hmm.
right? But for those of you doing $500 to $1,000 a month, you want to have at least a 10 to 15 year horizon to fund this.
And that time will fly quickly, but it's going to allow you to put yourself in a place that just that cash value grows exponentially. Is the rule of 72 involved on this?
100%.
If you guys don't know about the rule of
compound
72, compound interest, we should maybe make that another topic because that is so. I think Einstein said that was the
eighth wonder of the world.
Eighth wonder of the world. The rule of 72. Look into that. There's a book that I read. It's a very small book. I think it's called The Retirement Miracle. It has a golden egg. Are you familiar with that one?
Yes, I am.
It's that big.
It's a good book.
But, as a matter of fact, I will include a link below for that book. But it's really, really good. Gives you a very general concept, overlying concept of an IUL. But it's incredibly important, and it's a quick read, but it's lots of value for that. We touched on in IUL versus institutional banking, and I thought it's important just to recap on this. And for those of you who don't know or have never heard of what fractional reserve banking is, I looked up the definition, and it says it's a system whereby banks loan out a certain amount of deposits that they have on their balance sheets. So again, you are depositing 10 grand into your savings account. They're in turn lending that 10 grand out 10 different times, or eight or 10 different times.
For every dollar you give them, they can loan it out 10
times, right? So, and that's legal, which it should not be legal for them to do, but they changed the books years ago. And so this is an opportunity for you to take that power away from them. You said earlier, don't bank on yourself, bet on yourself, right? This is a way for you to bet on yourself instead of banking with a big institution and be able to really reap the benefits and kind of work the same system in your favor.
Yeah. So I guess, and just in wrapping up with that, listen, you know how the bank works, right? It's robbery, in my opinion. If you can do the same for yourself that benefits you and your family and earn a much better ROI, why not take advantage of that opportunity, right? It's possible.
Just as long as you understand the concept behind it, know that there's a plan in place and there's a method to this madness. But if you're able to grasp the overlying general concept, this will be, just you're setting yourself up to win. And again, hopefully you all find value in watching these shows. And we try not to make them too long for a reason, because we want to get a general idea in regards to each episode. But this is why we're doing this episode. This is Dollars and Cents with David and Carlo. And we hope that you continue to hang out with us and really, interact with us and continue to watch us. So we're at the end of this show. Carlo, thank you again. Pound. And we'll see you guys soon. Peace.